Hi everyone, I'm Steve Minnell, the CFO at AFMA Wealth Management and Trust, and your host for today's webinar, Investor Behavior 2. I'm speaking to you from our headquarters in Fayetteville, North Carolina. Joining me from our Reston branch is Arthur Lyons, our Senior Relationship Manager in Virginia. We have about 35 minutes of slides for you today, and then we'll leave plenty of time for your questions. Since you are muted, please ask your questions by typing them into the questions block on your screen. This monthly webinar series is brought to you by AFMA Wealth Management and Trust. We are AFMA's trust company. AFMA is the American Armed Forces Mutual Aid Association, which was formed in 1879 as Army Mutual Aid to provide prompt and substantial relief to survivors of soldiers killed in action. Today, we continue that legacy of protecting members of the military community with comprehensive financial solutions. At AFMA Wealth Management and Trust, we accomplish this by being the premier provider of financial planning, investment management, and trust services for the military. As a trust company, we have an additional legal obligation to act as your fiduciary. That is only in your best interest, for your benefit, and not for our profit. Here's an important disclaimer. This presentation is educational. It is for general information only and is not specific investment, legal, or tax advice for any of you individually. So please do not rely on this presentation alone to guide your financial planning decisions. Since each individual situation is unique, your needs for financial services will obviously differ. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members and to help them better understand the resources that are available to them. In this case, today's presentation by Arthur is going to focus on investment management. This is our agenda today. First, Arthur will set the stage by reviewing some key points he covered last year in his first webinar on this topic. Next, he will examine how emotions affect investor returns in a macro sense. Then he will explore specific investor emotions and how they cause suboptimal investing behavior. Finally, he will explore some simple steps that we as investors can take to profit from this understanding of emotional effects. I'll be back in about 35 minutes to moderate Q&A. So please ask your questions by typing them there in the questions block, or if you're attending live, feel free to ask questions at the end. Okay, let's go ahead and get started. Arthur, the mic is yours.
Okay, well, thank you, Steve. Initially, we're going to talk about, hey, what did I miss from the first webinar? Go back over defining behavioral finance and examining some of the types of something called micro biases. So let's advance the slide here and ask ourselves once again, hey, what is this stuff? Well, when we talk about behavioral finance, what we're doing is we're trying to apply psychology to the financial and investment areas, and that can be done on a very broad basis, and we call those macro biases for the most part. And then on a very personal basis, we refer to those as micro biases. And then there's an up-and-coming field of study called money scripts in financial therapy, and that's where you drill down not only deeper, but you also look at preceding generations, you know, and their relationship, their personal and emotional relationship with money, and how they felt, you know, as a child growing up, how it's impacted their relationship with the spouse, with parents, and also their current spending and savings habits. Now, we're not going to go into that today. We already explored that in the last one, but this entire field of behavioral finance is very, very intriguing on a personal level. So when we talk about investor biases, you know, what is a bias? Well, it's a preference or an inclination that favors a certain viewpoint or inhibits impartiality. And from an investor standpoint, that's really the part that can get us into trouble. Now, everyone has one or more biases. That's just human nature. Now the key is to understand which ones that you have, and then begin to identify how they are affecting your investments. And then once you understand that, you can take corrective action. So, everybody has a bias on how we process information, how our brains are hardwired, and how we view the world. The key really is to just identify that, manage it, and move on. So with microbiases, in the previous webinar, we talked about big picture stuff, and then we also talked about those personal biases, and that's really what we're going to focus on today. And there's two types: a cognitive bias, which comes from faulty mental reasoning, selective memory, information processing. Really, a cognitive bias is how your brain processes information, how you see the world, and there's very little that can be done about that. It is what it is. I don't even think that there's pharmaceuticals that can change the way that we're hardwired without causing a great deal of problems. So cognitive bias kind of is what it is, but we're going to focus on the emotional bias, which seems like a spontaneous feeling. It really isn't a spontaneous feeling. It comes out of a decades worth of experiences and situations that we've been in. But these emotional biases are spontaneous feelings and emotions that are going to cause us to think less than rationally. And so that's what we're going to laser in on, things that prevent investors from succeeding. So emotions affect returns, and let's look at which emotions occur within a market cycle, and also is there research to support this idea? I mean, we're kind of throwing out these ideas, but what kind of research really supports that? So let's take a look at these things. First of all, there's the idea of efficient market theory, and efficient market theory, we've had a number of very brilliant people that have earned Nobel Prizes by developing various types of investment processes based off of efficient market theory. And this theory really implies that no amount of information or analysis will result in outperformance. And the reason for that is efficient market theory believes that prices immediately reflect all the known information that's out there. Then there are derivatives of the efficient market theory, but essentially that's the primary focus and thesis of that theory. Now, here you've got Benjamin Graham, and with this startling quote. Now, Ben Graham, for those of you that don't know him, professor of finance at Columbia University, in 1934 wrote the ultimate book on value investing. He made his career essentially off the idea of exploiting markets that are inefficient. That's the whole premise behind value investing and small cap investing. Many of you have heard of one of his proteges, a guy by the name of Warren Buffett, who's legendary for his investment skill, which, when you think about it, flies directly in the face of efficient market theory. Because, in other words, if markets are so efficient, then how is it that Warren Buffett is able to outperform the markets consistently over long periods of time? Now, this quote from Graham that says, "The investor's chief problem, even his worst enemy, is likely to be himself." I mean, I put that up there because it's very interesting to me, because Graham's investment ideas just by themselves would have built fortunes for many people. But apparently he also believed, even way back in those days, that this behavioral component was especially critical for investor performance. Warren Buffett's made similar comments in that he's often wondered why people don't invest the way that he does. So apparently he's also believing that there's some type of behavioral component that drives investor returns and how we make those decisions. Now, let's begin to overlay and take a look at the feelings that occur during the course of a market. So, you know, as the market's going up, we've got this optimism. It turns to excitement. It turns to thrill. I love the smiley face that says I'm brilliant, because I'll never forget in the early 80s the slogan that was going around, which is "Don't confuse brains for a bull market." But of course, it's easy to do that, and then you get this feeling of euphoria. And euphoria, there's been nothing like the late 90s, where people would quit their jobs, mortgage their house, go to work for a day trading firm, and begin trading stocks of which they knew nothing about, didn't even know the name, just knew the symbol. That is euphoria, well defined. Then as things start to slip and slide a little bit, that euphoria starts to turn into anxiety, and then a bit of denial. Hey, maybe I'm a long-term investor and I don't have to worry about this. But ultimately, it ends up in capitulation. I will never buy another stock again. And I remember, again, starting my career in 1980, there were still folks from the 1973-74 bear market that said, I'm never buying another stock again, ever. And which is sad, because look what the markets have done since that period of time, with the Dow Jones at 700 in those days. But that was the potential, the highest potential for earning at that point. And then the cycle repeats itself as we come out of that. So all of those feelings, you may recognize some of those, you may have experienced some of those, and now let's take those feelings and overlay it with price action in the market. Now, there's nothing really scientific. I mean, nobody is, there are investor sentiment measurements out there. There are organizations that do take polls about how money managers are feeling, how investors, retail investors are feeling. This chart is not based on that, but I would imagine it would be fairly close. And those of you that suffered through 2008, 2009, you probably had some of those feelings of anxiety going all the way down to despondency. Unfortunately, I've come across too many folks that have been in that capitulation, despondency phase, but they never get back in. And if you look what the market's done in the past, 5, 6 years, it's tragic missing out on that. Now, as a firm, we're kind of wondering here whether or not the euphoria that we see in 2014 is starting to tilt a little bit more towards the anxiety level. We've actually been in the most narrow trading range in the market that we've had in 100 years, and so some folks are starting to get a little bit antsy about that. So we may be starting to turn over to the anxiety level as far as that's concerned. I'm not trying to guess the top, but that's just a little bit of what we see. Now, that is, those are the feelings that we have. We overlaid it to the market. But let's take a quick look at some of the research, and there are a number of studies that kind of validate what we're talking about. Various studies are attributing consistent retail investor underperformance. They attribute that to investor behavior, and the one that's been out there the longest with Dalbar for over 21 years, they attribute an underperformance from the market of 5%, 500 basis points. Now, Dalbar has come under some criticism for their methodology and their calculations, but I think the fact that we have a number of other studies corroborating and saying the same things, whether the actual number is 1.5% or whether it's 5%, is almost immaterial. The fact is there is a significant underperformance component due to investor behavior. New York University, with their 15-year study, they think it's 2% a year. Morningstar has done a couple of studies that have spanned 10 years, and then Emotional Investor, with their 20-year study, they put their range between 2 and 4% of underperformance, and they all attribute it directly to investor behavior. So clearly, while the research methods may be a bit suspect or crudely done, there is a picture starting to formulate there that investor behavior is really starting to cause underperformance. Now, I find this next chart a bit interesting. Again, going back over the decades, when the idea is that mutual funds are long-term investments, and I do remember seeing folks that have held the same fund since the 1950s or the 1960s and accumulated a lot of money. But recently, over the past 20 years, Jay Moreland of Emotional Investor is finding that these long-term investments are only being held for about 3 years, 3 to 3.5 years for equity and fixed income funds. That's not even a full market cycle, which has traditionally been 4 to 5 years. Then asset allocation funds, whether you call them life cycle, lifestyle, target date funds, only manage 4.5 years on the retention. So clearly something is at play here when you have traditional classic long-term investments being held for less than a market cycle. So why don't we start to explore then some of the emotional causes, and we're going to look at some of the primary emotions, and then what does this mean for an investor? So we're going to focus first on these behavioral biases. There's been about 20, a little over 20, that have been identified now as either a cognitive or an emotional bias. And previously, in the first investor behavior webinar, we talked about cognitive dissonance. We talked about a status quo bias. I'm not going to go over those today. I will encourage you to take a look at that webinar that's still up on our website. But today I wanted to focus on 4 of the biases that I'm seeing a lot of and have seen a lot of exhibited over the past 6 to 12 months. So I wanted to share some of that with you, and those are regret, overconfidence, something called recency, and then hindsight. So let's take a look at the regret characteristics. And some of those characteristics may sound like this. Hey, I don't own enough of whatever stock when it's going up, but boy, I own too much of it when it's going down. Or another comment might be something along the lines of, hey, I want to outperform the market when it's up, but I really don't want to lose principal when it goes down. And so when I hear an investor saying that they want all of the upside, but they don't want to lose, then I know that they're starting to display strong feelings of something called regret aversion. They want to do anything they can to avoid this very strong feeling of regret. Part of the problem with that, however, is that regret feelings cannot account for and cannot deal with the normal amounts of historical volatility that are inherent in the market. So, for example, the market, we know from 80, 90 years of price history, the market goes up about 65% of the time, but that means it goes down 35% of the time. And it's during that 35%, sometimes it can lead to panic selling. At the same time, some of that 65% going up can lead to panic buying. Because what happens, it's almost counterintuitive, but somebody with regret characteristics and regret aversion, they really begin to overestimate their ability to take risk. By that I mean, if they see something going up, they're going to regret not owning enough of it. And so consequently, an investor that maybe should only own 50% of his assets in the stock market might ramp it up to 80, 90, or 100%. They might even go out and borrow money, as I saw in the late 90s. And this kind of trend-following behavior perpetuates a selling low or buying high type of an approach, which is horribly painful. And along with that, they're going to be feeling a lot of distress, not just from the things that they did, which are acts of commission, but from the things that they wish they had done, or wish they hadn't, or wish that they had done, which is an act of omission. So there's an enormous amount of internal conflict for somebody that is carrying around these characteristics of regret. The next bias is that of overconfidence. Sometimes investors believe that they know more than they really do. And there's nothing more wrong with being confident. I mean, we're all in the military. I mean, that's the way that we're trained. We're well trained. We feel confident about undertaking a mission. And the same way on the investing side, nothing wrong with being confident, especially if that confidence is grounded in sound investment principles. But there's a danger with overconfidence if it's grounded in either a short-term success, a short-term event, a supposed insider knowledge, or just even random chance. So what occurs then is that prediction overconfidence leads to something called overcertainty, which leads to an investor chasing the next hot investment. It leads to them sometimes holding a losing position far too long, and risk management goes out the window. And from my personal experience, I remember in my 20s doing research on stocks and thinking, hey, I've found a great idea here. I should buy 100 shares. And then you start to feel more confident about the position. Well, gee, if I think it's going to do well and I own 100 shares, why not 500 shares? Why not 1,000 shares? And so consequently, the idea of being wrong didn't even cross my mind. So risk management goes out the window. And usually that's going to manifest itself in an under-diversified portfolio. And by that, I mean 1, 2, maybe 3 or 4 stocks. You see that a lot with company employees that have very large concentrated positions. You see that with folks that are enamored with technology and they hold technology stocks. And of course, the worst of both worlds would be a company employee of a technology company. Now, my wife worked for the Gillette company in the 80s and 90s, Gillette Shaving Company. That was a fantastic stock. If you own that one stock, made a lot of millionaires. However, I have met too many people that worked for Enron or WorldCom or HealthSouth or some of those guys, and that did not end well for them, as did the employees of probably 70 or 80% of the dot-com companies in the late 90s. So overconfidence can be a double-edged sword for sure. Now, I came across this little game here. I thought it might be fun to play to kind of drive home the point. And that is in 1896, the Dow Jones Industrial Average was at 40. Hard to believe that. By 100 years later, 1998, it was at 9,000. Now, the Dow Jones Industrial Average is a price-weighted, price-driven index. It does not take into account dividend reinvestment. But if dividends had been reinvested as they were paid out over those years, where would the average be in 1998? So with a high-low range of whatever you want that range to be, with 95% certainty, what would that range be? Now, for example, for me, I'm going to select a range of Dow 10,000 to Dow 40,000. That would be my high-low range with 95% certainty. So take just a minute here, think it through, and then we'll show you the answer in just a few seconds. So now that you've formulated your 95% confidence range, Steve, let's show them what the answer is. 632,230. That would be the Dow with dividends reinvested. Ironically enough, I could say with 95% certainty nobody has gotten that right. probably that's listening. I've never known anyone that's ever come close. But the idea is to drive home the fact that confidence in and of itself does not mean that investment results will be positive. All right, let's take a look now at recency. Studies have shown that we tend to place more weight and more importance on recent events and information that we heard most recently. We tend to remember things better, let's say in a speech that we've heard, all of those things that were said last. Not the things that were said in the beginning or even so much in the middle, but those things at the end. That's why with most everything, whether it's a performance or a speech, anything, we want to finish strong because people remember that. Be it right or wrong, that's it. Now, with recency, what happens is that people will begin to extrapolate a trend from a small data set. For example, a long-term investor looking at the market price action over the last 3 or 4 months and then trying to extrapolate a trend from that. Hey, the market has returned 1 or 2% return. Hey, I could have gotten that with a CD. Why should I be in the market? They're extrapolating a trend from a small data set. The focus tends to be only on price, not on value. Again, late 90s was the classic time when value went out the window and people were only looking at price action. And so that's part of the recency idea. Hey, the stock's at 90 today, it's at 100 tomorrow. What do I care about value? I'm only focused on price. So consequently, the expression, it's different this time. You remember the new economy that we were supposed to be entering. It's different this time kind of became the mantra. Now, it may be different this time. There may be, it seems like in every decade, some variation of economic events, technological breakthroughs, political events. There's some variation of those kind of events that occur that may make it seem like it's different this time, but however, the outcome will still be the same. Price follows earnings, always. Eventually, it will do that. Equity risk premium outperforms bonds. It will eventually do that. But when we're tied up into recency and we're only looking at small data sets, what happens then is that we ignore proper asset allocation, we ignore rebalancing, and because we're remembering these events most recent to us, we start to anchor our expectations to that information. And anchoring is another bias that's tied to so many other things like recency. And we've all done anchoring of one sort or another. When we go to sell a house and we ask the real estate agent, what she thinks it's worth, and she says it's $400,000. And she says, hey, I'll probably get $400 for it. But then she goes, well, I want to make it sell fast, so we'll list it for $390. And then somebody comes in and gives you an offer at $370. You might turn it down because you're still anchored to that $400,000. Hey, she's telling me $400,000. Or maybe you accept the offer, but you have a great deal of angst over that. And we also do that with stock, with stock prices. Stock hits a new high, it goes from, goes up to 200. We think it's going to go higher, but it falls back to 190. So we keep holding on for that 200 plus number. Then earnings come out, stock drops to 160. Now it's trading at 155. You might recognize this as IBM that I'm referring to. And so, if you're anchored to that 200 or to that 220 number that you saw somewhere or heard somebody say, then it makes it really tough to sell a losing position. So that's recency, and it can be a tough one to deal with as well. Now, finally, we have hindsight, and we've all dealt with hindsight in some form or another. But I'm talking about hindsight bias, such that we're actually rewriting the memories, and we're rewriting history to avoid facts. And really, this is one reason why we try to avoid back-tested investment models, especially back-tested trading models, because what happens as we're rewriting the history, these events begin to be portrayed as predictable, and all the things leading up to those events get portrayed as being predictable. I mean, you know, I remember the biggest one-day crash in the market, October 19th, 1987, and truly the market was in dire fear of a real meltdown. Not politicians saying that, actual investors, you know, the next day on October 20th. And so the Federal Reserve was able to provide liquidity and avoid that. But it's amazing to me how many people saw the crash coming, the crash of '87. They saw that coming, but not until 1988 or not until 1989. It's amazing all the people that came out of the world. Hey, well, yeah, it was obvious. You know, you could see this happen or this happen, and so you know that kind of hindsight bias is devastating because you know it's easy to avoid responsibility and you know start to blame another person or you blame an outside event for failure. But anytime you avoid personal accountability, then you either build in a victim mentality or you start to have rose-colored glasses with things, and of course that's going to lead to excessive risk-taking. But worst of all, it prevents us from learning from mistakes. Now, all of us in the military have done an after-action review. That essentially is kind of a hindsight exercise. We're looking at what worked, what didn't work. Well, that's a positive. That's not a bias. That's trying to use hindsight to learn from mistakes, but a hindsight bias is going to actually rewrite everything and keep us from learning from those mistakes, which makes it doubly devastating. Now, what are the implications for investors? Well, certainly behavioral biases can lead to negative results, and we've discussed some already. Improper asset allocation, and improper meaning, for the most part, excessive risk-taking. It also leads to emotionally driven trading, and that is why people buy tops and sell bottoms. Now, that is going to also manifest itself in emotional distress, and I always tell people, listen to your body, listen to what's going on around you, listen to your spouse, because this emotional distress will manifest itself with poor sleeping, poor appetite, you know, what I jokingly say, kicking the dog, but, you know, irritability, argumentation, relationship issues. That's nature's way. That's your body's way of telling you you're taking too much risk, that you're in an investment position that is not comfortable for you. So ultimately that leads to poor investment results, especially if we don't listen to that. Now, there are real positives in recognizing these biases, especially within the context of an investment management relationship. And I'm talking about like AFMA Wealth Management and Trust, the relationship that we have with our clients and working through their investor behavior, understanding and coming to grips, you know, this idea of self-discovery is extremely important. You know, I understand that, you know, as current and former military, we're generally not wired to be in touch with our inner self and our feelings. It seems a little bit too much touchy-feely, but I got to tell you, there's a great quote from a 1968 book that goes something like this: if you don't know who you are, the stock market is a terrible place to find out. So starting to come to a place of self-discovery really is a very big positive. And so some of the additional implications becomes a better understanding between the client's financial goals and the manager. If we as the manager understand our client's financial goals, their risk tolerance, what makes them feel uncomfortable, then that helps the process enormously. And along with that, then we start to begin to build realistic and understandable client expectations. So we start to rein in the excessive risk-taking. And then the manager is better able to consistently and systematically advise the client. And this leads to positive long-term outcomes. Now, notice I didn't say positive long-term return performance, because we're constantly having to balance not just returns, but risk, and come up with what we call, or what is called, a risk-adjusted performance. And that's ultimately what our clients are entrusting us to do. So how do we profit now from the self-discovery? Well, I've got some possible investor solutions, and then how we meld that in with working with a professional portfolio manager and what can happen. So let's say you've identified some biases there. Let's say that you've been listening to this and you see a little bit of yourself on one place or another. What's the solution to that? Because it's very hard to self-correct sometimes, especially if you've been in that mode for decades. Well, with an investment advisor, as you work with an investment advisor like us, we're going to be trying to set you up with the proper asset allocation, that proper blend of risk and return, and doing much more than just having you fill out a questionnaire. We spend hours and hours getting to know people and getting to know their spouse, getting to know what they've done in the past, where they are now, their feelings about money, their feelings about risk. Out of that becomes the idea of starting to learn and to teach more about what a long-term perspective looks like, what a long-term perspective feels like, and what that means historically, the expectations of return that the market generally delivers. Diversification is a great solution that would help avoid overconfidence and even recency to some degree. So all of those are very helpful solutions, very effective solutions. And of course, as a manager, we're going to meet regularly with our clients. And sometimes we even have event-driven contact, let's say after a 9/11 type of an event or a 2008 type of an event, and then investor education on an ongoing basis. What all of this does is that these areas then become reinforced into what will then be new investor behavior, and then the outcomes are going to be better, either from an emotional or from a return standpoint. Now, why hire an investment fiduciary? First of all, I use the word fiduciary as opposed to a broker or advisor or whatever, but most people are familiar with brokers. Brokers have a suitability standard. They have to select and recommend products and services that are what they think are suitable for the client. A fiduciary like ourselves, like the trust company here, we have to go beyond the suitability standard. We have to put our client's interests first and invest as a prudent person would, as a prudent investor would. So it is a much higher standard of investor care and diligence and professionalism than just, hey, is this suitable? We have to actually put ourselves in the client's spot and do what we would have done in that particular case. Now, Ben Graham, another great quote, successful investing professionals are disciplined and consistent, and they think a great deal about what they do and how they do it. And when I think about the past 35 years for myself, yes, I love this industry. I love everything about it. Rick Convey, our Chief Investment Officer, over 40 years of experience. Yes, we think a great deal about what we do, and we do enjoy it. And so generally the members that hire us to manage their portfolio, they're not only looking at us to help them through these behavioral challenges that we've talked about, but many of them, they just want to go on and live their life. They want to enjoy their retirement. They want to go play that golf. They don't want to be glued to the Wall Street Journal, to CNBC, to the Bloomberg, to all of that. So there's a lot of reasons to hire us, and that may be because of expertise, but it also may be for time constraints. It may also be for the idea that we have that discipline and that consistency in our investment approach so that we can now remove all of those behavioral bias barriers. So now, working with AFMA Wealth Management and Trust, the client sets the agenda with us. We don't put them in a box. They tell us where they want to be, what they're comfortable with, what level of risk feels good for them. And so this significant client input is extremely important. And ultimately what comes out of that is a very personalized asset allocation. You know, we have an asset allocation questionnaire. A lot of firms have questionnaires, and they can be from 10 to 50 questions. And those are nice tools, but in my mind, there's nothing better than sitting down with somebody and over hours and hours of conversation and learning about that person and where they've been and what they've done and what they'd like to do and the mistakes they've made and the successes that they've had. There's nothing like those kinds of experiences to personalize an asset allocation approach. We reinforce long-term expectations. We're not market timers, but we do have a very disciplined and systematic approach to investing that ultimately we're trying to manage risk and develop risk-adjusted returns. And for us, the relationship with the member is paramount, because that's where we avoid mistakes, and that's where we can build on successes. So finally, in working with us, there's two things that we offer everyone. One I would call an investor behavior checkup, and that may be nothing more than just having a conversation with someone about, you know, again, what they've done, where they've been, where they want to go from an investment standpoint. You know, kind of go through some self-discovery and see, you know, what might be preventing them from reaching the goals and having the successes that they would like to have. The other thing that we offer is a free investment portfolio analysis, so we can analyze the current portfolio, look at the historical risk, and then give you our opinion on the risks currently and what we think the future risk for that portfolio might be. And so, you know, if you're interested in going through either one of those processes, it's very easy. All you have to do is contact us. And Steve, if you'll put up our contact information on the next slide, you can feel free to give me a phone call, or you can send an email, and we'll be happy to get back to you and begin those conversations and walk with you on this process of self-discovery, which ultimately will lead to a happier life, less emotional distress, and hopefully better risk-adjusted returns. So Steve, with that, I'm going to conclude my remarks and open it up to any questions that might have come in.
Super. Thank you, Arthur. That was an excellent discussion of how common emotional biases can negatively affect how we manage our money. Now, what are your questions for Arthur? We collected a few questions earlier. I do not see any in the questions block, so if you feel like typing one in there, please do. So don't hesitate to type something in there. As a senior relationship manager, Arthur, the guy there on your screen, is one of the wealth management professionals around which we build our client service teams. So depending on your personal needs, those teams might also include a financial planner, the investment officer, a trust officer, or an account administrator. I'll leave Arthur's contact information up here displayed as we go through Q&A. Before I throw out some of the questions that we took in earlier, Arthur, do you have any questions there that you've gotten in the room?
No, not so far.
Okay, so I'll start off with some of these that we received earlier with the registrations. First, you told us about some of these free or complementary services you might provide, but what does it actually cost for your investment management service?
Well, the investment management service we feel like is based on probably the best approach to charging fees that our industry has devised, and that is a fee-only approach. We will charge a flat fee annually based on the assets under management. So we don't charge commissions. We don't have other products that we sell that have hidden fees, like an annuity. We don't have any mutual funds with a name on it. So we don't have any conflicts in terms of wanting to sell something to someone, quite frankly. So it's a fee-only approach, which our industry has determined is probably the fairest approach, where we can actually be on the same side of the table as our clients.
And can you describe what those fees are?
Oh, sure. Yeah, they're fully disclosed. It's 1% annually, which, by the way, is billed every quarter, a 0.25% each quarter. 1% annually on the first $500,000, then 0.8% on the next $2 million above that, and then the fee slides down above $2.5 million as well. So that's it. There are no commissions or any other fees.
And you've spoken a lot about investment management. That's obviously been the focus of this presentation. But can you talk a little bit about the other services that we offer at Athma Wealth Management and Trust?
Yeah, sure. Because we provide a full service of wealth management and trust. We offer comprehensive financial planning. So for a flat fee, we can do some very complex modeling and what-if scenarios based on a variety of events or possible events in somebody's life. And then also we're a full-service trust company chartered out of North Carolina, but we can provide trust services in over 40 states. So either as trustee, co-trustee, or trust agent, we can provide those services as well. So altogether, we've got clients that will hire us for maybe one of those, or in other cases, one will blend into another, which blends into another.
All right, so here's a question. I'll answer. I've got a kind of an administrative question that just came across. Someone asked, will the slides of today's presentation be made available to attendees? The answer to that is sure. If you'd like a copy of the slides, and I know the person that asked wants a copy of the slides, just ask us and we'll go ahead and email them out to you. And I'll have some more administrative comments at the end about a recording and another email you're going to get. Okay, so back to the subject of the presentation. Somebody this morning asked, I'm anxious, what should I do?
Well, if somebody is feeling anxious about their investment portfolio, my suggestion is to give us a call, because again, that's kind of nature's way of letting you know that you're feeling uncomfortable with where you are. And so it's very helpful to have a discussion with an objective party to see why it is that you're feeling anxious, and if there is a basis for that anxiety. Should changes be made? Maybe they don't need to be made, but it's always helpful to get an objective opinion on that. So the anxiety may not be grounded in investment principles, but it's always helpful to talk through that.
And a good follow-up question was, how do I know that you as an investment manager will be more rational than me?
I've been asked that a lot in the past few decades, and it's a fair question because we're all human. The difference is this. An investment advisor like ourselves has a systematic, disciplined an investment methodology to how we manage client portfolios. Most people don't have that, but we have that. That's why people hire us. They expect us to do that type of work in a consistent, disciplined fashion. And it is precisely that methodology that keeps us from making the mistakes that I mentioned in these certain biases. We are diversified. We are long-term investors. We do determine proper asset allocation. And so, that's the very essence of why you would bring us on, and that's what keeps us from those biases.
That's good answer. I have my last question here, so long as nobody else wants to pop another one into the questions block there. If you do, we still have some time. Last question, same one as this morning. I liked your response. And I've wondered why this question hasn't been asked of you more often. The question is, how is it that a Sergeant First Class in the Army has 35 years of investing experience?
Well, I've been a reservist and in the National Guard. I'm currently in the National Guard, and I, enlisted in 1977. But as you know, with the National Guard and the Reserve, it's 1 week in a month, 2 weeks in the summer. So for decades, I was able to develop my investment career, did a lot of traveling during that period of time, and still serve my military obligation. Now, I took kind of an odd route. I was out of the Reserve for 21 years, and so at the tender age of 48, I decided I had some unfinished business, and I re-enlisted in the National Guard. I've been mobilized to active duty on 2 different occasions to work with wounded soldiers, and was able to develop financial planning and financial life skills programs specifically for our wounded. So I've been able to build my civilian career, and at the same time I've been very proud of my service to my unit and to the country in the National Guard, and have loved every minute of it. And I appreciate you asking that question, Steve.
And we did get another question that came in, and this is a good one, and I'll kind of lead off with a little bit of my perspective on it. So the question is, how tuned in are you to the current changes to DoD retirement systems? Are you capable of constructing case scenarios based on that new guidance? So my initial response to that is, yeah, a lot of us are retired or still serving like Arthur, and we pay a lot of attention to this. That's a response to the first question. Second part is, one of the unique things about our financial planning capability is that you do have people here who understand military pay and benefits, and how that is, in many cases, very different than civilian pay and benefits. And so when we do financial planning and we are modeling cash flows and doing sensitivity analysis on those cash flows, yeah, absolutely, we can look at different types of retirement systems. Arthur, did anything else pop to mind about that question?
No, well, one of the things I hear most of all is, hey, I'm working with an advisor, but he just doesn't factor in the survivor benefit plan that I've got, or he doesn't understand that I'm on TRICARE for life. So I do hear that a lot, and when you've either lived through it or all the elements of those particular programs, yeah, it does go to the heart of being able to build an accurate plan and do some accurate investment allocation throughout the process. So I would second what you'd have to say there, Steve.
Okay, so I don't see any more questions right now. Those were really good questions. If we didn't fully answer your question, or you think of another question later, please reach out to us at wealthmanagement@afma.com. It's still up there on your screen. We'll break here for now, but you can always find us when you need to. Please don't hesitate to ask for help. This is what we do, and as Arthur said, we love it. This weekend, you will receive a follow-up email with instructions on how to access a recording of this presentation. And you can always sign up for future webinars or review past webinars at wealth.afma.com. That's up there too. That's a little bit of a new web landing page for us, wealth.afma.com. If you found this information useful, please share it with your family and friends. Our membership grows stronger every year because you introduce your eligible friends to AFMA. We hope you'll join us again in September for our next webinar. And thank you and have a great day.